briefing of the week, 16th of December. And for the trainees, your final kind of day of this month. Not really a great deal for me to talk over this morning, so this briefing is probably going to be pretty brief. It's more, I guess, just recapping largely some of the big events that we've had more recently and where the kind of land lies at this point. And I would say today, barring anything unexpected, is probably going to be fairly quiet, and then next week, of course, will be pretty dead, given that most people will be out of the market by that point. Liquidity will drop substantially, so it'll probably be a lack of price movement, as is always the case every year into that run up to Christmas. So I guess starting with the euro currency, there's obviously been a very interesting one yesterday. Some of the lowest levels we've seen in a very long time, initiated by really two events that have occurred in the last week or so. Obviously the first being that of the ECB, which came with that move there really over that period of the initial decision. Obviously we blipped higher. That first headline that came out, that kind of 60 billion, caused many to think that, wow, the ECB are tapering. But then when the details started to come through about the extension to the timeline of 9 months rather than 6, the buying of lower end bonds to 1 year from 2 year on the lower bound, and then also the ability to buy in terms of below the deposit yield floor when necessary, and then also and most importantly the fact that they said that they would review it again even at the end of that program. So they left it quite open-ended. And so extremely dovish in that sense. The euro came under aggressive selling pressure for really 2 days. We leveled out, and then of course the Fed have come in and really renewed the selling pressure in the pair on the back of a really strong move up in the dollar. The fact that the projections out of the Fed were slightly on the surprisingly hawkish side, as too was Janet Yellen, who would more typically be very cautious and dovish. She was more optimistic than she usually is on her assessment of the US economy. And then if we look slightly longer dated, you can see here that key level got broken yesterday, and that just kind of exacerbated the downside. That double bottom from 2015 got taken out yesterday, and then as you can see from this chart, which is obviously going all the way back to the inception of the euro, we're now at levels not seen since really the beginning of 2003. And certainly this has now increased some of the calls that will ultimately move technically below these levels, given the fundamentals and the growing divergence of monetary policy between the more hawkish Fed now. And one of the reasons why the Fed was interpreted to be hawkish is that she was already being quite optimistic on the economy and with rate trajectory. This was even without really the fiscal element coming into play yet, which is only probably going to heighten that view. This, of course, in comparison to more political uncertainty, which is likely to be a real key theme going through certainly the first half of 2017. We've still got Italy to really resolve on that situation. You've got the triggering of Article 50 by the end of March, if not sooner. And then you've also got those French presidential elections as well. So whether we get to parity, I would say the likelihood of that is fairly strong, but the timelines, I think, are a little longer than possibly or some were thinking. Parity year end is definitely, I don't think, going to happen, but certainly in that Q1 period, that could be certainly, once we break further from here, most obvious target to push to, and will psychologically be a huge level when we get to that point. So that's kind of the Euros story. The other one that's been obviously very much in focus more recently has been Treasury yields. Obviously we went through 2.5% probably around a week ago now, and since the Fed we've just continued to extend that. You can see the quite violent and more directional move that we had when we were trading you guys were looking at the night of the FOMC announcement. It was very tricky actually to call the equity market, but the yield move in combination with the strong dollar was certainly a much more cleaner play. And looking that more longer dated as well, if I look at that candle there, I'm just hovering my mouse on at the moment, that was obviously the US presidential elections, and then ever since that point, I mean, we've got, when we're on a high on that wick at 131, we're now down at 123 handle, and obviously 122 and a half would be very significant from a technical perspective, just underlying the price point or the low from 2014, which would then put us back down to levels haven't seen since 2011. So certainly something to watch there as well in the weeks ahead. The S&P, obviously you had Vass on the squawk yesterday with the strategy. We were having a bit of a debate about, okay, at this point, how do you feel sentiment-wise about where US equities are going? Obviously, this was the move that we had ultimately on the FOMC. It was pretty choppy. It sold off, moved up to pivot, then sold off again. Net, it was a downward move, but then it was kind of, where do we go from here? Is this going to now trigger some of the selling and the profit taking on these really elevated all-time record high levels in the SPOs, or are the fundamentally the dominoes are still lined up to lead us higher in regards to the Fed's overall optimistic view of the economy, which, if anything, has been supplemented by pretty strong US economic data, and then also still with this fiscal element to come into play, which is going to add a further stimulus to US economic growth. So I think still at this point, I certainly into year end, I would still be having a kind of a long bias in US equities, but I think it'll probably go into more consolidation mode around this kind of all-time high levels now from where we are at the moment. I think if I was just to look at this a bit longer dated, I know this is a bit messy with the various markings that I've got on this chart, but it kind of puts it in a bit of context to where we've come from. Obviously, this is the election, really strong move higher, a bit of a hiatus around that 2200 level psychologically, and then a push up again. Probably I'd say you're going to consolidate really between 2250 and the all-time high at 78 and a quarter now, as markets really start to die down. Just looking then at some of the just headlines. As I say, it's been very quiet news-wise. There's not really much for me to get you up to speed on, other than a couple of, I guess, more general, interesting comments, so to speak. Data-wise, you've had French business confidence that jumped to a 5-year high this morning. Monty de Paschi gets green light for a fresh debt-to-equity swap. They've gained stock market approval to extend a voluntary debt for equity swap to retail investors, a crucial plank of the lender's attempt to raise that much-needed 5 billion euros in capital before the Christmas period. Some other headlines you may have seen me tweet, although this is really not market moving on an intraday basis. It's certainly worth just noting Japan has overtaken China as the largest holder of US treasuries. Obviously, we were talking in the run-up to Trump about how he would deal with the relationship with the Far East, and China being very critical to that, given they historically have been the largest holder of US debt. But I think it's the 5th month that treasury holdings in China have depreciated as they try to offload dollars to counter the yuan's weakness through their own currency's devaluation. Quite an interesting graphic that I saw, which I didn't actually know of until this morning, but Ireland is actually the 3rd largest creditor of the US. Japan and China obviously absolutely huge, but Ireland are the 3rd, then Cayman Islands, Brazil, we go all the way down to the UK, probably in the 8th spot or so. But looking into that, the reasoning being, much like a lot of business goes to Ireland on the corporation tax front, which at 12.5%, well, is it still 12.5%? Correct me if I'm wrong, if anyone, if it's been updated, but that's against a global average of 24%. So obviously Ireland highly competitive in that regard. And a potential explanation, the large number of fund managers and other companies based in the country for those tax incentives. This is an old stat, but more than 700 US companies are domiciled in Ireland. You know those headlines about Facebook and Starbucks and so on. So that's probably where a lot of that comes from. Other headlines I've seen from last night. This was another one. Again, I think this is not having an impact on the pound this morning, but certainly these are the types of news or stories that you're probably going to hear over Christmas, as this Brexit kind of toing and froing from Europe hasn't really got underway, but it's more kind of the threats before the negotiations get underway. So the UK facing a Brexit settlement bill of up to £50 billion, according to Sky sources. European officials saying this isn't a fine or a payment to leave, this is just the outstanding commitment of bills they've already signed up to in terms of Britain in the agreement already. And so it's kind of like settling your debt, so to speak, in terms of how Europe will see this. But obviously the UK will certainly have something different to say. So if you hear from the Chancellor today or other officials, David Davis, then the Brexit minister, you're probably going to hear him rebutting this comment to some degree. I don't really see that as having, though, much of a wider implication for sterling. The other thing I was going to have just a quick look on is this old infographic that we've looked at before, which is kind of the political timeline, because certainly this will be a big factor going into 2017 in Q1 and really the first half of the year. So following the structure through, we've obviously had the centre-right primaries in France, the Italian referendum, the Austrian presidential election, and so the score is almost 2-1, if you like, in terms of on a populist basis. Austria being the only one where that Green Party candidate came victorious, whereas now we move down to late Jan. We'll get the socialist primaries in France, but really these are a non-event. The presidential runoff is going to be very much on the other political spectrum, so it's more of a Fillon against Le Pen situation, which is likely to occur. So the socialist primaries are really a non-event. UK to trigger Article 50, end of March. That's obviously the timeline put forward by the government more officially, but you've had Hammond just this week talking about it's possible that could happen earlier. The general election in the Netherlands, that's kind of another one to look out for. Similar situation, I would say, with populist parties gaining more traction, so that could be interesting. Then we start to look into German state elections, which will be watched more closely ahead of the actual federal German election. Does not take place until October the latest, September time. But obviously the state ones will be watched very closely in regards to how Merkel is faring on her party on these regional breakdowns. Then we go into the big one, which will be the presidential and general election in France. That's the end of April and beginning of May. So that's kind of the main timeline, I guess, you want to be looking out for in that respect. But looking at today's session, just going back to the intraday, as I say, I think things might have the propensity to be very quiet as a lot of traders, fund managers and so on start to kind of wrap up, close their books for the year. No real need now to get involved in this market with the lack of volume and liquidity. Much of the business already done. Certainly the big events of the year, the Fed really was the final rubber stamp on 2016 to some respect. So looking at the calendar, you've got Eurozone CPI at 10 o'clock, but the F denoting this is the final reading, so again it's not really going to have much influence on the euro. This is just confirmation from a statistical revision basis. And then moving on from the UK, CBI industrial trends, the Bank of England's quarterly bulletin, these are all non-events as well. Housing data from the US, as we said before, is very much backseat on the Fed's agenda, where they're more focused, I'd say, on inflation, wage growth, employment, those kind of parts of the economy. A couple of questions this morning that I had in regards to Draghi. Is he speaking today? Because it's on the calendar. It's written here that Draghi's participating in the European Council meeting in Brussels, but I've checked with the official press office of the ECB, and he's not officially scheduled to speak. Likelihood he's probably just in attendance and participating within a meeting, but nonetheless, I'll keep you posted, of course, on the mic if he does say anything monetary or economy-based comments. But that's pretty much it. I know some of you in the month 1, month 2 might have your trading competitions going on today, so I guess my only advice here would be you're probably going to be better suited to just finding decent technical levels, playing the range to a certain extent, and I would say probably with a bias and a continuation of the general trends that we've seen of late, i.e. dollar strength, higher US yields. Technically now Euro's broken that key level, and he pulled back to there. Might be another opportunity to re-enter the short. Cable sitting just shy of pivot at the moment. Could be interesting, obviously, just given that defined kind of that high print from yesterday evening, and also if you carry that view that the dollar might re-strengthen again to close out the week on the back of what's unfolded with the Fed, then certainly that could be of interest as well. So, okay, guys, going to leave it at that. Have a good session, and I guess I'm not sure the exact detail, obviously, for trading live next week. We're not going to be online. The Squawk service will be operating as per usual, so you can certainly turn that on if you're still trading for the live guys. If I can, I'll try and continue to do a morning briefing, but I think in all respect, probably what I'll do is just tweet out, continue to be quite active on that every morning, tweeting out the main stories, but it's probably, I would say, not worth me really doing these video briefings, given the market will likely be very quiet. If something exceptional happens, of course, I can jump on. I'll be keeping an eye on things, and I can deliver either a live session or a video recorded briefing if it helps. But I wish everyone a fantastic Christmas. The guys at home, if any of you are coming down to join us for drinks later, I know there's a big gathering going on, internal guys and externals as well, so hopefully I look forward to seeing you there. If not, Jimmy, Rabia, Jen, so on, some of the other guys, Michael, I know I can't go through and name you all, but thank you very much for a great year. It was, for those who are in-house, very nice to meet you, and then hopefully I'll be seeing you, or some of you at least, later on tonight. So have a very Merry Christmas and a great New Year if I don't speak to you before then, and have a good day. Thank you.